Hi everyone. So this module is going to cover chapters 11 through 13 about long-term financing decisions. So there was a lot of information contained throughout chapters 11 through 13. A lot of it that was, I felt, at least a little bit beyond the purposes of this course. So what I did is took the most pertinent information, kind of condensed it down into this module. So what we're going to talk about today, please continue to read through your textbook, but for purposes of your exam, the information presented on these slides, you're not going to see anything extra appear on the slide or on the exam beyond these slides. Now that doesn't mean, do not read your textbook because there's going to be some additional information for points that I go over throughout today's module, but there will be no new information presented on the exam. So we'll go ahead and get started. Again, today this is chapters 11 through 13, so we're going to be looking at bonds. We're going to talk about cost structure, cost of capital, and some other different components that go into long-term financing decisions. So the first thing we'll start off with is bonds. And we'll start talking about zero coupon bonds. Again, you guys know I love short little videos. So I'm going to use this to kind of set me up for what we're going to be talking about over the next couple slides. Oh, sorry, the volume's not coming through for some reason. Let me see what's going on.
What is a bond? Presented by WallStreetSurvivor.com. What is a bond? Presented by WallStreetSurvivor.com. A bond is a contract where a company or government borrows money from a person for a period of time in return for interest payments. Think of it as a company or government taking out a loan directly from an individual. There are two kinds of bonds, coupon and zero coupon bonds. With coupon bonds, the lender lends a set amount to the borrower. The borrower will make periodic payments to the lender and then return the money to the lender at the end of the term. With a zero coupon bond, the lender lends a set amount to the borrower. The borrower, however, doesn't have to make payments, but will return a larger amount to the lender at the end of the term. Companies usually issue coupon bonds, while governments usually issue zero coupon bonds. The key things to look for in a bond are the interest that the bond pays, the number of times interest is paid, the end of the bond term, and the amount paid back at the end of the term. Here's Archie. Archie owns a construction company and needs $20,000 to buy new machinery. All his cash is tied up in other projects, so he needs to raise money. He has a few options. He can issue new shares in his business in return for money. He can take out a loan from the bank, or he can take out a loan from the public by selling coupon-paying bonds. Selling shares in his business can be tricky, and Archie has no interest in losing his ownership. Taking out a loan from the bank can be easy, but it would be on the bank's terms. Maybe Archie has already maxed out his credit with the bank, or isn't happy with the interest rate the bank will charge him. To avoid both these issues, Archie decides to issue bonds. He looks at his current interest rates in the market and sets a coupon rate. He would also decide payment terms by setting the coupon period and maturity date. Since the typical coupon bond sells for $1,000 and Archie needs to raise $20,000, he will issue 20 bonds. The $1,000 becomes the face value of the bond. It's important to note that bonds can be traded on secondary markets. Bond prices are affected by interest rates. As rates go up, bond prices go down. Bonds are a safe way to secure returns on your investment. They won't be huge, but they're pretty much guaranteed. To learn more about bonds, head to the Learn Center on WallStreetSurvivor.com.
Okay, guys, so just a little intro video just going over what bonds are and kind of set us up for the information we're going to be discussing over the next couple slides. So we know overall businesses, in order to get the assets that they need to provide services to their customers or their patients, they need to acquire a certain amount of capital to be able to purchase those assets and make those assets available to their customer base. So we have two forms of capital. The first, supplied by lenders, is the debt capital. and then those supplied by the owners or the community is the equity capital. Now, how we go about purchasing that capital or who gets what capital is really based on in the free market by the price, and that determines how capital is allocated out. So the businesses that are able to really pay the most get the most capital or are able to afford the most capital. A couple other key points that we want to know, particularly around the cost of money and talking about these more capital decisions. The interest rate on a debt security is the cost of that capital and really works to influence the cost of all capital. So we have four primary factors that are going to influence overall our interest rate. So those are our risk, our time preferences, which we talked about through our time value analysis, and we also touched on risk a little, inflation expectations, as well as investment opportunities. So when we kind of break these down and look at these individually, investment opportunities look to see the profitability level of the business. So the higher the interest rate, the higher that can be paid out to the lenders. Just to revisit time preferences for consumption, think back to our time value analysis. Investors have a certain amount of time to consume the capital that they could, before they consume capital that they could potentially invest. So think back to time value analysis when we talked about $1 today is worth more than $1 tomorrow, simply because the interest rate factor that goes into that. So when we look at time preferences for consumption, we're talking about the amount of time investors have to use their capital before they need to make an investment in it. Just revisiting a couple points we've already talked about before. Like I said, risk, we know there's inherent risk to the business. When we talk about long-term financing and capital decision making, this deals and revolves around the organization or the business's ability to repay any kind of loans that they take out. But what's important to remember here, the higher risk we are, so think of it in terms of this. If you have a very low credit score and you go out to apply for a loan, a mortgage, a credit card, something like that, the lower your credit score is, that's going to be indicative of what type of risk you're going to indicate to that potential lender. So we want really high credit scores, which would translate into lower interest rates if we're thinking about us personally going out to apply for loans or things of that nature. So the same thing is true here for organizations. The higher the risk that the organization is, the higher the interest rate they can expect to pay. And kind of going along those same lines, when we talk about inflation, the higher the expected rate of inflation is really going to dictate the level of demand that's out there. So the higher the rate of inflation, the higher the rate of the demand. So what overall do we know about short-term debt? So when we're thinking in the short term, we know short-term debt, we're talking about maturity of 1 year or less because it's short term. We're going to use to finance our temporary cash needs because this is short term, so we're going to be looking in the temporary, not the long term. And it's going to increase our inventories and receivables. So any kind of supplies that we need to buy to bring in to continue business as usual, this is going to relate back into short-term debt.